Hi, and welcome to this Introduction to Fibonacci Analysis presentation. This video is brought to you by Alpari. The Fibonacci analysis is, I think, traditionally thought of as a more advanced technical analysis tool. However, I think it's great for beginners as well as advanced technicians to be using as a way not just for us to understand where is support and resistance as we try to find entry opportunities, but where do we think the market may go? Where do we think the upside potential is? This is a great way to use a tool to identify our stop loss points or our entry points as well as our target levels. Where do we think the market might go? Now, Fibonacci analysis is based on the Fibonacci number series, and if you don't know what that is, it looks like this. So it starts with 1, well, it starts with 0, and then you go 1, and you add those two numbers, and you get the next one in the series, which is also 1. And then you get 2, 1 plus 1 is 2, 3, 5, 8, ... You get the idea. And essentially what happens is that the difference between sequential numbers and numbers that are separated by a couple of numbers in the Fibonacci series, the ratio between those two numbers are our Fibonacci ratios. So those include the most popular, most frequently used Fibonacci ratios are the 61.8% ratio, and I'm going to be explaining what these are here in a minute. The 50% Fibonacci ratio, the 38.2% Fibonacci ratio, 23.6% Fibonacci ratio. These are the retracement ratios that we're using to identify entry opportunities, support, and resistance. And we'll also be using Fibonacci ratios that are in reverse. So the 161% Fibonacci ratio, the 261% Fibonacci ratio. So these numbers are we're going to be using to try to find our projections. So where do we think the market is likely to go? Now we're going to start simple with just a few things, and I'll show you how to make this really easy. And from here you can start to really dig in to how Fibonacci analysis works and try to make it to conform to the way in which you want to use it. So let's look at a case study. We're going to be looking at the Euro USD, and I'm going to draw it on the board first just so we can get a feel for what this looks like, and then we're going to look at the actual chart. Now in the third quarter, fourth quarter of 2008, we had the Euro had started to break down from a consolidation up high and had begun to go down. Now no market goes down forever, or at least not in the currency market, and eventually they stop and consolidate, and in this case it did. It popped up. Now what we're looking for here with our Fibonacci analysis is once we've gotten a pretty solid correction, so this is not just 1 or 2 days of upside, this was a fairly large correction to the upside, then we know where our initial trend was. So our trend was from the top here to the beginning of this correction. And what we do is we apply a Fibonacci analysis to this, a retracement study to this trend. So we've got attached here to the top and attached here to the bottom. And what we're looking for is it's going to draw our Fibonacci lines. These are the 50% lines, the 38% lines, the 61% lines, on down the list. And at each of these lines is a candidate where the market is likely to run into a resistance level and begin to reemerge in its previous trend to the downside, which in fact happened at the 38.2% retracement level. Let's look at the chart. So as you can see here, the market stopped, turned around, we applied our Fibonacci retracements, and we're looking at each one of those Fibonacci levels as candidates where the market may reverse and continue its previous trend. Well, it finally hits that 38.2%, and we get this definitive breakdown to the downside. That's our opportunity. We already knew in advance the likely levels at which that kind of a correction or continuation of the downside would occur. So we've got a nice continuation of the downside, but we were able to identify that resistance level on this little correction by using Fibonacci retracements. However, we can also use a Fibonacci retracement to identify how far do we think the market is likely to go after that breakout. Now, in order to do that, we do this, is very similar, but it's kind of in reverse. So we're looking at the board again, and we've got the bottom of this correction and the top of this correction. What we're going to do is apply a Fibonacci analysis to this correction. But what I'm not interested in the levels that are going to bisect that little corrective trend. I'm not interested in that because what I'm looking for is I'm looking for my projection levels, my 161% and 261% retracement level. Well, this is where it gets really interesting, and the reason why there are 161% and 261% is because they are beyond the trend. So in this case, it's a 61% beyond the trend. In this case, it's 161% beyond the trend. These levels are very likely to be consolidation levels and are good target levels for us to start looking at, well, how far do we think this breakout is likely to go? Let's look at the chart again. As you can see, the market consolidated a little bit temporarily at the 161% retracement level, and then subsequently continued on to the 261% retracement level, which was about the extreme of that particular trend before bouncing back up. So we had a very good estimate of where our price is likely to go. This is really good. This is a really good analysis, especially when the market is trending very strongly, which is what it was doing in the latter end of the third quarter and the fourth quarter of 2008. So the perfect example of how to use Fibonacci analysis. Now here's what I would do if I were you and trying to internalize this information. I would apply a Fibonacci retracement to a couple of charts, and I'd replicate this analysis that I was doing. I gave you the dates. I'd replicate this analysis that I was doing on the euro. So you get a feel for what does this look like, and how do these retracements work, and what about these projection levels? What do they look like, and why would I want to use them? Could it help me in my analysis?
This video has been brought to you by Alpare.